Welcome to Iron Financial. Now, we're not here to chase trends or ride the latest wave of market hype. No, we're here to do the heavy lifting. We're here to forge portfolios that can actually withstand any market storm. You know, every single day, the market throws some new shiny object at us. And today, that object is a company called Buda Juice. It's got all the buzz, it's got a great story, but our job here, well, our job is to put it on the anvil, apply some serious heat, and see if there's any real, solid steel underneath, or if it's just going to shatter into a million pieces under the slightest bit of pressure.
All right, let's just get right to it. The company is Buda Juice. Ticker is BUDA. Now, this company just went public, and you got to admit, the story they're selling is pretty compelling. I mean, they're selling health, freshness, convenience, all the right buzzwords. But look, with any IPO, any new company hitting the market, we're always looking at a two-sided coin, right? On one side, it could be a ground floor opportunity, the kind of investment that can literally make a portfolio. But on the other side, it could be a value trap, dressed up to look pretty while it quietly drains your capital. So our mission today is simple. Figure out which side this point is going to land on.
Every single IPO kicks off with a story. It's practically a fairy tale designed to get you, the investor, excited. They'll show you these beautiful architectural renderings of a skyscraper. But our job, my job, is to kick the tires and, more importantly, check the foundation. We're here to look past all the marketing slogans and the slick PowerPoint presentations. We need to see if this whole company is built on solid rock, or if it's just a house of cards waiting for the first strong gust of wind to come along. So let's see what's really holding Buda Juice up.
Okay, so let's break down the actual business model here, because on the surface, it's pretty smart. They're positioning themselves as the pioneer of the ultra-fresh juice category. Now think about this. Instead of forcing grocery stores to deal with the labor, the waste, the whole mess of in-store juicing, Buda Juice comes in and provides a complete turnkey solution. The real core of their value proposition, the secret sauce, if you will, is this meticulously maintained 35-degree cold chain. It runs continuously from the farm to the processing plant, right to the bottle sitting on the shelf. This is what gives their products an 8 to 12-day shelf life without using any preservatives, all while hitting those key certifications, USDA organic, non-GMO. So you see, this isn't just a juice company. It's really a logistics and supply chain operation masquerading as a beverage company. And that's the powerful narrative that really powered their IPO back in January.
And of course, this is the message coming straight from the top. The CEO, Horatio Lonsdale-Hands, is basically painting a masterpiece for investors. Listen to the key words: double-digit revenue growth, remained profitable, generated free cash flow, all of it crowned by a successful IPO. I mean, this is the official story. It's the highlight reel. It's a statement that's been carefully designed to inspire confidence, to project this image of unstoppable momentum. It's a very, very powerful pitch. So the question is, does it hold up to some real scrutiny?
Yeah, I'll admit it. That pitch is smooth. It's polished. It checks all the right boxes you'd want to hear. But words on a press release don't pay the bills, do they? So I think it's about time we stopped listening to the story and started actually reading the numbers. We're going to grab our tools and drill down deep into their financials, because this, right here, is where the truth lives. Let's see if the balance sheet and the income statement sing the same pretty tune as the CEO.
All right, let's get into the engine room. Time to look at the numbers. First thing that jumps out, net sales for fiscal 2025 hit $12.6 million, up from $11.3 million the year before. So let's do the math on that. That's an 11.8% jump. Now, in a market as crowded and competitive as consumer beverages, double-digit top-line growth is a pretty significant signal. It tells us they're successfully taking market share. It tells us that customers are actually walking into stores and buying the product. The demand is clearly there. And for me, that's the first real solid pillar of a strong bull case.
Whoa, not so fast. That revenue growth? Yeah, it looks great in isolation. It's a beautiful number on a slide. But you've got to look deeper. Look at what's happening underneath. As their sales went up by almost 12%, their net income actually went down. And operating income? Completely flat, stagnant. This, to me, is the first major red flag waving in our faces. How on earth do you sell over $1 million more in juice and have less actual profit to show for it at the end of the day? It tells me one thing: their costs are spiraling out of control. It feels like they're running faster and faster on the treadmill, but the machine is so inefficient that they're actually losing ground. That's not a sign of strength. That's a symptom of a serious problem.
See, you're getting hung up on the short-term fluctuations, the year-over-year noise. You're missing the incredible structural strength that's right here. Just look at that net profit margin, 30.61%. Let me put that in perspective for you. In the food and beverage sector, that is almost unheard of. It's astronomical. Most companies would absolutely kill for margins half that size. This proves that their core business model is incredibly efficient and massively profitable.
So while the year-over-year income was flat, this underlying profitability is the bedrock of the whole operation. It shows they have real pricing power and a tight handle on their production costs. This is the sign of a disciplined operator, not some cash-burning startup.
Okay, I'm going to have to strongly disagree there. Look, accounting profit is an opinion. Cash is a fact. And the cash flow statement, the real story, tells a much, much bleaker tale. We're talking about free cash flow here, the actual spendable cash this business has left after running its day-to-day operations and investing in itself. And that number declined. It dropped from 3.3 million down to 3.0 million. So let me get this straight. Sales are up, but the actual cash in the bank is down? This just confirms the dangerous trend we saw in the income statement. They are spinning their wheels, working harder for less real return. That is a dangerous, dangerous trajectory for any company, let alone a new IPO.
Okay. Income and cash flow can be volatile. I'll concede that, especially for a young, growing company. But the ultimate test of a company's durability, its raw ability to survive a crisis, that's its balance sheet. This is the concrete foundation of the entire financial structure. It's what holds everything else up. So let's stop arguing about the plumbing for a second and examine the bedrock. Have they built a fortress, or is this whole thing just a sandcastle waiting for the tide to come rolling in?
And right here, this is the absolute core of the bull case. Look at that number on the screen, 0. That is the amount of corporate debt on their books, nothing. In an era where companies are practically drowning in leverage, Buda Juice has built its entire operation on pure equity. This is what we mean when we talk about a true fortress balance sheet. They don't have to answer to bankers, they aren't exposed to rising interest rates, they can weather practically any economic downturn because their foundation is solid, unencumbered steel. This is what real financial resilience looks like, period.
A fortress? You call that a fortress? You know, a structure is only as strong as the people who command it. A balance sheet with no debt is great. I'm not going to argue with that. But it means absolutely nothing if the governance, the leadership, and the oversight structure is fundamentally deeply flawed. You can have the thickest castle walls in the world, but if there's no one properly guarding the gate, it's totally worthless. And in this case, a critical load-bearing component of this so-called fortress is completely missing. I'm not just seeing a little issue, I'm seeing a massive crack in the armor.
And here it is. This, right here, might just be the fatal flaw. According to their own public filings, Buda Juice has zero independent directors on its board. Now let me spell out exactly what that means, because it's crucial. An independent director's job is to represent the shareholders, guys like you and me. Their job is to provide objective oversight and to challenge management when they need to be challenged. Here at Buda Juice, every single board member is an insider. There is no one sitting at that table whose sole duty is to protect the interests of outside investors. For a publicly traded company, this isn't just a red flag, it's a complete structural failure. It's unacceptable.
So why is this a deal breaker? Why does it matter so much? Well, because without independent oversight, who challenges the CEO? Who questions the strategy when profits are falling, even though sales are rising? It creates this closed loop, this echo chamber, where the insiders can make decisions that benefit themselves, not the public shareholders who actually own the company. Accountability is just gone. This is a foundational crack in the armor, and it is precisely the kind of massive governance risk that makes professional, institutional money, the smart money, stay far, far away.
The governance issue is a serious one. I will grant you that. It's a major concern. But with numbers this strong on the surface, we're talking double-digit growth and a 30% margin, you'd still expect someone on Wall Street to be taking notice, right? I mean, professional analysts are literally paid to find opportunities like this, which in theory should provide its own form of external scrutiny. But that just raises another really uncomfortable question. Where are they?
And, well, there's your answer. Another big, fat 0. This company is trading on the NYSE American exchange, a major public market. And yet there are exactly 0 Wall Street analysts covering the stock, not a single one. That means no research reports, no earnings estimates, no price targets, nothing. It's a complete ghost town. For an investor, this creates a total information vacuum. The company is basically operating without any kind of third-party professional validation or scrutiny whatsoever.
You know, this quote from Simply Wall Street just nails the consequences perfectly. It says, because there are no analyst forecasts and because the company is too new to have sufficient historical data, it is functionally impossible to build a reliable valuation model. Think about that. You can't project the future based on the past, and you can't rely on expert predictions because none exist. So as an investor, you are being asked to fly completely blind. The company isn't a company, it's a black box.
And let's be perfectly clear, this is not normal. This is extremely unusual. Simply Wall Street covers thousands of public companies, and 97% of them have enough data for some kind of forecast. Buda Juice is in that lonely, isolated 3%. And this isolation is itself a massive red flag. It means the entire ecosystem of professional analysts, the people who do this for a living day in and day out, have looked at this company and have collectively decided to pass. That silence is a verdict in and of itself. They are voting with their attention or lack thereof, and they're staying away in droves.
All right, so we've laid out all the components. We've stress-tested the numbers, we've inspected the foundation, and what we have is a tale of two companies. On one side, we have a set of really solid-looking financials and a very compelling product. But on the other, we have these deep, undeniable structural flaws in the company's governance and its transparency. So it's time to put it all together, weigh all the evidence, and deliver the official iron financial verdict.
So, in the end, it really just comes down to this. The bull case is built on tangible, pretty impressive numbers. You've got nearly 12% revenue growth, a stellar 30.6% profit margin, and a pristine, totally debt-free balance sheet. It paints a really compelling financial picture. But the bear case exposes the massive cracks in that very foundation. Stagnant profits, declining cash flow, and then the critical failures of governance. No independent directors and zero analyst coverage. And these aren't just minor blemishes we're talking about. They are fundamental flaws that threaten the entire structure of this investment.
So our verdict here is unequivocal. In its current form, Buda Juice is a speculative trap, not a durable investment. The attractive surface financials are completely and totally undermined by the severe underlying risks. The absolute lack of independent oversight, combined with the total absence of external validation, makes this an unacceptable risk for anyone who is serious about building a resilient, long-term portfolio. It's a beautifully decorated house of cards, and we will not be using it to forge anything.
But look, we're not just here to tear companies down. That's not the point. So here is a clear, actionable roadmap for Buda Juice if they ever want to be considered a serious investment by us or anyone else. Step 1, and this is non-negotiable. Fix your board. Appoint truly independent directors who can provide real oversight. Step 2, come out of the shadows. Actively seek out and get legitimate coverage from at least 2 reputable Wall Street analysts. Subject yourselves to professional scrutiny. And step 3, prove it. Deliver a full year of sustained, profitable growth as a public company and show the market your model is actually sustainable. Until those 3 things happen, this stock remains firmly on our avoid-at-all-costs list.
And we'll leave you with this question to apply to every single company you analyze going forward. Is a clean balance sheet really enough to make you ignore the red flags? A company can look absolutely perfect on paper, with great sales numbers and no debt. But if the governance is broken and transparency is completely non-existent, are you actually investing or are you just gambling? Understanding that fundamental difference, well, that's the key to forging a truly durable portfolio. Thanks for joining us on Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.